All right, let's talk about something that's affecting millions of us. The whole world of remote work has shifted from a temporary fix to a permanent reality. But here's the problem, our tax code is completely stuck in the past. Today, we're doing a technical deep dive into this new tax minefield. Because let's be honest, getting this wrong can cost you thousands, but getting it right, well, that's a real strategic advantage. So let's get into it.
Our source material for this explainer calls the situation a labyrinth, and trust me, that is no exaggeration. It's an absolute maze of federal laws, state rules, and IRS rulings that often seem to contradict each other. One wrong turn, and you could be looking at paying taxes twice on the same income or losing out on deductions you thought you had. Our whole goal here today is to basically hand you the map to get through it.
So here's our game plan. We're going to break this down into 5 key parts. First, we'll cover the new laws that really change the whole landscape. Then, we'll get into the single most important concept, your federal tax home. After that, we dive into the wild world of state tax rules. This is where that double taxation risk really comes into play. And finally, we'll get super practical with the home office deduction, looking specifically at Form 8829 for all you self-employed folks out there.
Okay, first things first. The ground has permanently shifted under our feet. A 2025 law, nicknamed the OBBBA, locked in a couple of huge changes. For all you W-2 employees, listen up. That suspension of miscellaneous itemized deductions under IRC Section 67G, for things like your home office, that's permanent now. They're not coming back. And for everyone, the cap on state and local tax deductions, the SALT cap, got bumped up to $40,000, which creates a whole new set of strategic puzzles.
Now for what is, without a doubt, the most important concept we're going to cover, your tax home. And look, this isn't just some casual phrase. It's a specific legal term straight from Internal Revenue Code Section 162A2. And here's the number one mistake I see people make, over and over again. They assume their tax home is where they live. To the IRS, that is very often dead wrong.
So here's the official definition. The magic words, the ones that change everything, are at the very end. Regardless of where they maintain their family residence, the IRS does not care about your personal home. They care about your economic home. So think about it. If your company's main office is in New York, but you decide to work remotely from your house in Florida, the IRS says your tax home is still New York. And that one simple fact has massive implications for what you can and cannot deduct.
But what if you don't have a main office? What if you're a true digital nomad? Well, this is where you can stumble into a really nasty tax trap, being classified as an itinerant. Let me be clear. From a tax perspective, this is the worst-case scenario. It means your tax home is wherever your laptop happens to be on any given day. And if you're never away from home, guess what? You can't deduct any of your travel expenses. None of them.
So how does the IRS figure this out? They use a 3-part test, laid out in Revenue Ruling 73-529. Now, all 3 factors matter, but the one that trips up most digital nomads is number 2, duplicate living expenses. It's simple, really. If you have an apartment in Austin, but you're on a work trip to Denver, you're paying for 2 places to live simultaneously. You're duplicating costs. But if you just give up your apartment to travel the world, you aren't duplicating anything. You fail that part of the test, and it becomes nearly impossible to argue you have a tax home to be away from.
The length of your work assignment is also a huge factor. And the IRS isn't always straightforward. But on this, they have a very simple bright line rule from Revenue Ruling 93-86. It all comes down to 1 year. If your gig is expected to last less than a year, it's considered temporary. Your tax home doesn't move, and you can deduct your travel. But the moment that assignment is expected to go longer than a year, it becomes indefinite. Your tax home officially shifts to that new city, and all those expenses, your flights, your hotels, they just became a non-deductible personal commute. Okay, so what happens if you're juggling multiple work locations? The courts, like in the landmark case Markey v. Commissioner, use a 3-factor test to pinpoint your principal place of business. And it's not just about where you spend the most time. They're also going to weigh the amount of business activity at each spot and, most importantly, where the bulk of your income comes from. It's all about finding your true economic center of gravity.
All right, so we've sorted out the federal tax home, which is all about what you can deduct. But that leaves another massive question unanswered. Which state actually gets to tax your income? And this is where things get really messy. A huge conflict has emerged between 2 totally different ways of thinking. The physical presence rule versus the much more aggressive convenience of the employer rule.
Now, the physical presence rule is simple. It makes perfect sense. You pay tax in the state where you are physically located when you do the work. Easy. But then there's the convenience of the employer rule, or COE.
A handful of states use this, and it says that if your company is based in their state, they get to tax you, even if you never set foot there, unless you can prove working remotely is a necessity for your employer, not just a perk for you. This rule is exactly how people end up getting taxed by two different states on the very same paycheck.
And if you want to see the COE rule in its most extreme form, just look at New York. For a remote worker to escape New York income tax, they have to prove their home office is a bona fide employer office. You've got two shots at this. Path A is almost impossible. It's for people who need, say, a specialized film editing suite at home. That leaves Path B, which is this incredibly complex, multi-factor test that's notoriously difficult to pass.
And just look at how high they set the bar here. To pass, you need to check off a bunch of these boxes. Things like having a separate business phone line, getting your home address printed on company letterhead, maybe even putting a sign outside your house. I mean, come on, what major corporation is going to do that for a remote employee? Let's be real. This test is deliberately designed so that almost no modern remote worker can ever pass it.
And don't think this is just a New York problem. It's not. Other states like Alabama, Delaware, and Pennsylvania have similar aggressive rules. Nebraska even has a version that can get triggered if you're physically working there for more than 7 days. The big takeaway here is that this is a moving target. States are constantly changing the rules, which means you have to stay vigilant.
Okay, let's switch gears. We've been in the state-level minefield, so let's get back to a federal benefit. But I have to preface this. This is now almost exclusively for self-employed individuals. We're talking about the home office deduction. And the single most important thing to understand about the law here, IRC Section 280A, is that its default setting is no. The law starts by saying you cannot take this deduction, and then it carves out a few very narrow, very strict exceptions.
When you look at the actual legal text, you can see this thinking in black and white. The law doesn't start by saying, here's how you can claim a deduction. It starts by saying, you are disallowed from taking this deduction unless. The entire structure puts the burden of proof 100% on you, the taxpayer, to prove you fit into one of those tiny exceptions.
So what are these hoops you have to jump through? Well, there are a few big ones. First is the exclusive and regular use test. And exclusive means exactly what it sounds like. If your kids use your office computer to do their homework, boom, you failed the test. Done. Second, it has to be your principal place of business, which has a really specific legal definition thanks to the Supreme Court case Commissioner v. Solomon. And that third test for employees, as we said, it's suspended, so for W-2 folks, it's a moot point.
Okay, so let's say you are self-employed, you've jumped through all the hoops, and you actually qualify. Now what? How do you get this deduction onto your tax return? Well, that's where we move from the legal theory into the practical reality of filling out IRS Form 8829.
The way this form is calculated is kind of like a waterfall. First, you can never deduct more expenses than the gross income you made from the business use of your home. And second, you have to deduct expenses in a strict tiered order. You start with Tier 1, things like mortgage interest and property taxes. If you still have income left over, you can move to Tier 2, utilities, insurance, then Tier 3, and so on. If you run out of income at any point, any remaining deductions just get carried forward to the next year.
Now, this is probably the biggest strategic point in this whole section. You might be thinking, hey, isn't there a simplified method for this? Why bother with all this paperwork? And you're right, there is. But here's the multi-$1,000 catch, that $40,000 SALT cap. If you use a simplified method, all your property taxes stay on Schedule A, where they can easily get wiped out by the SALT cap. But with the regular method on Form 8829, you strategically move the business portion of those taxes over to your Schedule C. Now it's a fully deductible business expense that also reduces your self-employment tax. For high earners in high-tax states, this isn't a small detail. This is a game changer.
And that brings us to the final question you have to ask yourself. When you look at this whole new world, is your remote work setup a tax risk, or is it a strategic opportunity? For W-2 employees, honestly, it's mostly about managing risk, about dodging the bullets from these aggressive states. But for the self-employed, this incredibly complex system actually creates real opportunities to save significant money. The rules are a labyrinth, for sure, but if you have the map, you can turn what feels like a headache into a real financial advantage. The only question left is, which side of that line are you on?